Welcome back, today's first episode of Section C, Performance Management. The questions will be presented in a series of successive episodes. Please follow the channel and like the video to support us in completing and covering all the questions of the first part. We inform you that the questions for 2023 and the second part are being prepared. Today's questions: Flexible budgeting and performance analysis. Next episode: Cost and variance measure, with the remaining questions about flexible budgets and performance analysis. Let's start.
Flexible budgeting and performance analysis.
Question 1. The difference between the actual amounts and the flexible budget amounts for the actual output achieved is the A. Budget variance, B. Sales volume variance, C. Standard cost variance, D. Flexible budget variance. The correct answer is D. Flexible budget variance. The flexible budget variance measures the difference between the actual amounts and the flexible budget amounts for the actual output. Question 2. The purpose of identifying manufacturing variances and assigning their responsibility to a person/department should be to A. Pinpoint fault for operating problems in the organization, B. Determine the proper cost of the products produced so that selling prices can be adjusted accordingly, C. Use the knowledge about the variances to promote continuous improvement in the manufacturing operations, D. Trace the variances to finished goods so that the inventory can be properly valued at year-end. The answer is C. Use the knowledge about the variances to promote continuous improvement in the manufacturing operations. The purpose of identifying manufacturing variances and assigning their responsibility to a person/department is to promote continuous improvement in the manufacturing operations. Question 3. Olive Industries produced 30,000 units this month and used 36,000 machine hours. The company's static budget for manufacturing overhead costs based on 37,500 machine hours is as follows. Variable: indirect materials $441,000, indirect labor $630,000, factory supplies $63,000, fixed depreciation $189,000, taxes $31,500, supervision $157,500. During the month, Olive's actual costs were $11.80 per machine hour for indirect materials. What is the amount of difference for indirect materials shown on the company's manufacturing overhead flexible budget report? A. $1,440 unfavorable, B. $1,500 unfavorable, C. $16,200 favorable, D. $1,500 favorable. The answer is A. $1,440 unfavorable. Flexible budgets are prepared after a period is over to show budgeted amounts for the actual level of activity achieved. Since indirect materials is a variable cost, the amount in a flexible budget will be different from the amount in a static budget to the extent that the actual activity level differs from the activity level used to prepare the static budget. Olive's budgeted amount of indirect materials is $11.76 per machine hour, $441,000 divided by 37,500. If 36,000 machine hours are used, the indirect materials in the flexible budget will be $423,360, $11.76 times 36,000. The actual amount of indirect materials is $424,800, $11.80 times 36,000. Since actual spending is $1,440 more than the flexible budget amount, the $1,440 variance is unfavorable. Question 4. Under which of the following circumstances would a financially favorable variance not be truly favorable? A. A company saved money by purchasing cheap cloth dye that produces environmentally hazardous byproducts. B. A company saved money by switching to a different raw material supplier. C. A company saved money by replacing an old machine that was inefficient. D. A company saved money by firing several employees who had a habit of calling in sick at least once per week. The answer is A. A company saved money by purchasing cheap cloth dye that produces environmentally hazardous byproducts. Correct. Variances are classified depending on how they impact actual net income relative to net income in the static budget. Any variance that would increase actual net income relative to budgeted net income is a favorable variance. Two reasons for favorable variances are paying less than the standard cost per unit of an input or using less than the standard amount of the input per unit of output. While favorable variances result in actual costs being lower than standard costs, they are not always good for the organization. One example of a favorable variance not being good for the organization is when lower quality cloth dye than called for is purchased. The lower quality dye will likely cost less than the standard, resulting in a favorable price variance, but the hazardous byproducts produced will likely be expensive to address and may result in lower selling prices. In this case, the favorable variance is not good for the organization. Question 5. Clover Company produced 20,000 units this month and used 24,000 machine hours. Clover's controller prepared the following static budget for manufacturing overhead costs based on 25,000 machine hours. Variable. Indirect materials $294,000. Indirect labor $420,000. Factory supplies $42,000. Fixed. Depreciation $126,000. Taxes $21,000. Supervision $105,000. During the month, Clover's actual costs were $1.75 per machine hour for factory supplies. What is the amount of difference for factory supplies shown on the company's manufacturing overhead flexible budget report? A. $5,320 favorable. B. $1,680 unfavorable. C. $1,750 unfavorable. D. $0. Budgeted and actual costs were equal. The answer is B. $1,680 unfavorable. Flexible budgets are prepared after a period is over to show budgeted amounts for the actual level of activity achieved. Since factory supplies is a variable cost, the amount in a flexible budget will be different from the amount in a static budget to the extent that the actual activity level differs from the activity level used to prepare the static budget. Clover's budgeted amount of factory supplies is $1.68 per machine hour, $42,000 divided by 25,000. If 24,000 machine hours are used, the factory supplies in the flexible budget will be $40,320, $1.68 times 24,000. The actual amount of factory supplies is $42,000, $1.75 times 24,000. Since actual spending is $1,680 more than the flexible budget amount, the $1,680 variance is unfavorable. Question 6. A company has a direct labor price variance that is favorable. Of the following, the most serious concern the company may have about this variance is that A. The circumstances giving rise to the favorable variance will not continue in the future. B. The cause of the favorable variance may result in other larger unfavorable variances in the value chain. C. Production manager may not be using human resources as efficiently as possible. D. Actual production is less than budgeted production. The answer is B. The cause of the favorable variance may result in other larger unfavorable variances in the value chain. In any situation, and in any organization, all variances in the value chain must be analyzed to assure that any unfavorable variances are scrutinized and, if possible, fixed to be more adaptable to changes in operating activities. Question 7. In the Procter Company, indirect labor is budgeted for $24,000 and factory supervision is budgeted for $8,000 at normal capacity of 80,000 direct labor hours. If 90,000 direct labor hours are worked, what would the flexible budget total be for these costs? A. $32,000. B. $36,000. C. $33,000. D. $35,000. The answer is D. $35,000. Correct. Flexible budgets are prepared after a period is over to show budgeted amounts for the actual level of activity achieved. Fixed costs are the same in a static budget and flexible budget as fixed costs do not change when activity changes. Variable costs in a flexible budget will be different from variable costs in a static budget to the extent that actual activity level differs from the activity level used to prepare the static budget. Since factory supervision is a fixed cost, it will be the same amount, $8,000, in the static and flexible budgets. Since indirect labor is a variable cost, it must be adjusted for the different level of activity. The budgeted amount is 30 cents per direct labor, $24,000 divided by 80,000. If there are 90,000 direct labor hours, indirect labor will be $27,000, 30 cents times 90,000. The total flexible budget for 90,000 direct labor hours is $35,000, $8,000 plus $27,000. Question 8. Tyler Strings uses flexible budgets. Tyler's normal capacity is 2,800 violins per year. At this level of activity, budgeted manufacturing overhead is $89,600 variable and $252,000 fixed. Tyler's actual overhead costs were $350,000 when 3,150 violins were produced. If Tyler uses a flexible budget, what is the difference between actual and budgeted costs? A. $8,400 favorable. B. $8,400 unfavorable. C. $2,800 favorable. D. $2,800 unfavorable. The answer is C. $2,800 favorable. Correct. Flexible budgets are prepared after a period is over to show budgeted amounts for the actual level of activity achieved. Fixed costs are the same in both static budgets and flexible budgets, as fixed costs do not change when activity changes. Variable costs in a flexible budget will be different from variable costs in a static budget to the extent that actual activity level differs from the activity level used to prepare the static budget. The budgeted amount of variable cost is $32 per violin, $89,600 divided by 2,800. If there are 3,150 violins produced, variable manufacturing overhead will be $100,800, $32 times 3,150, in the flexible budget. The total flexible budget for 3,150 violins is $352,800, $100,800 plus $252,000. Since actual spending is only $350,000, the $2,800 variance is favorable. Question 9. Fortune Corporation's marketing department recently accepted a rush order for a non-stock item from a valued customer. The marketing department filed the necessary paperwork with the production department, which complained greatly about the lack of time to do the job the right way. Nevertheless, the production department accepted the manufacturing commitment and filed the required paperwork with the purchasing department for the needed raw materials. A purchasing clerk temporarily misplaced the paperwork. By the time the paperwork was found, it was too late to order from the company's regular supplier. A new supplier was located, and that vendor quoted a very attractive price. The materials arrived and were rushed into production, bypassing the normal inspection processes, as directed by the production department supervisor, to make up for lost time. Unfortunately, the goods were of low quality and created considerable difficulty for Fortune's assembly line personnel. Which of the following best indicates the responsibility for the materials usage variance in this situation? A. Purchasing, marketing, and production. B. Purchasing and marketing. C. Marketing and production. D. Purchasing. The answer is A. Purchasing, marketing, and production. In this situation, purchasing had ultimate responsibility of the quality of the materials included in this order. However, given that all departments had a hand in pushing this order through the system quickly, each department has the responsibility to ensure the quality. Question 11. Identifying an exception under management by exception uses these criteria. A. Materiality and frequency. B. Controllability and frequency. C. Controllability only. D. Materiality and controllability. The answer is D. Materiality and controllability. Management by exception involves focusing management's attention on areas where actual performance varies significantly from budgeted performance. It allows management to better use its time to address performance issues. Materiality is an important criterion to use in identifying exceptions for management to consider, as addressing more material items will result in greater benefit to the organization than addressing less material items. Controllability is also an important criterion to use, as a manager's time will be wasted if he or she attempts to address an issue that he or she does not control. Question 12. A company's master budget for the year planned for the manufacture and sale of 5,600 toys for 750,000 yen in revenue, 400,000 yen in variable expenses, and 255,000 yen in fixed expenses. By the end of the year, the company had manufactured and sold only 4,500 toys for 650,000 yen in revenue, 375,000 yen in variables expenses, and 195,000 yen in fixed expenses. What is the operating income variance for the company for the year? Asterisk source, retired ICMA-CMA exam questions. A. 15,000 yen unfavorable. B. 25,000 yen favorable. C. 75,000 yen unfavorable. D. 100,000 yen unfavorable. The answer is A. 15,000 yen unfavorable. The operating income variance for the company is 15,000 yen unfavorable. Budgeted operating income is 95,000 yen, actual operating income is 80,000 yen, and budgeted operating income is 15,000 yen higher than actual. Question 13. Carton Manufacturing decided to purchase raw materials from a new supplier for a cheaper price, but after a couple of months they found that the new materials were of an inferior quality. How would this affect their variance? A. They would have a variance that is favorable for both price and quantity. B. They would have a favorable price variance and an unfavorable quantity variance. C. They would have a variance that is unfavorable for both price and quantity. D. The company would have an unfavorable price variance and a favorable quantity variance. The answer is B. They would have a favorable price variance and an unfavorable quantity variance. They would have a favorable price variance and an unfavorable quantity variance. Correct. Variances are classified depending on how they impact actual net income relative to net income in the static budget. Any variance that would increase actual net income relative to budgeted net income is a favorable variance, and any variance that would decrease net income relative to budgeted net income is an unfavorable variance. Two reasons for input variances are paying a different amount than the standard cost per unit of an input and using a different amount than the standard amount of the input per unit of output. One variance can sometimes impact another variance. One example is when lower quality materials than called for are purchased. The lower quality materials will likely cost less than the standard price, resulting in a favorable price variance. At the same time, lower quality materials are often harder to work with and result in excessive waste, resulting in an unfavorable quantity variance. Question 14. Sarah's Seamstresses employs 15 unskilled seamstresses and 8 skilled seamstresses. 1 week in November, 9 of the 15 unskilled workers called in sick with the stomach flu. Because the skilled seamstresses did not have enough work to do with the lower production by the unskilled seamstresses, some of the skilled seamstresses performed tasks normally done by unskilled seamstresses. What effect would this have on the company's direct labor variance? A. The direct labor price variance would be unfavorable. B. The direct labor price variance would be favorable. C. The direct labor quantity variance would be unfavorable. D. The total direct labor variance would be unfavorable. The answer is A. The direct labor price variance would be unfavorable. Correct. Direct labor variances arise for a number of reasons. Having higher skilled workers doing tasks normally performed by lower skilled workers will likely result in the actual labor price being higher than the standard labor price. This higher price results in an unfavorable direct labor price variance.